This content is for educational purposes only and is not financial advice. Consult a qualified advisor before investing. Hello and welcome back to Understanding Money. Today we're diving into a core debate for beginner investors: ETFs versus mutual funds. Both vehicles let you own a diversified basket of stocks, bonds, or other assets, but they differ in structure, costs, tax treatment, accessibility, and convenience. By the end of this video, you'll have a clear framework to choose the right option for your personal goals and circumstances. Ready to simplify your portfolio building? Tap like, drop a comment with your biggest funds question, and subscribe for weekly investing breakdowns. First, let's define our terms. An exchange-traded fund, ETF, is a pooled investment that trades on stock exchanges just like a share of stock. A mutual fund pools money from investors to buy securities, but is priced once per day at its net asset value, NAV. Both let you access broad market exposure, think thousands of stocks in a single trade, but their mechanisms and features vary. Section 1. Intraday trading versus end-of-day pricing. ETFs trade continuously from market open to close. You can place market orders, limit orders, stop-loss orders, or even use margin and options on ETFs, just like individual stocks. This flexibility means you can react instantly to news, execute trades at your chosen price, or trade during extended hours. By contrast, mutual funds accept buy or sell orders only once per day after markets close. You place your order at any time before the cutoff, usually 4 p.m. Eastern, and you receive that day's NAV price, which reflects the aggregate value of the fund's holdings. This approach prevents intraday speculation, but removes timing uncertainty and micromanagement from your investing. Section 2. Fee structures and expense ratios. Both ETFs and mutual funds charge an expense ratio, an annual fee expressed as a percentage of assets under management. However, ETFs, especially passive index ETFs, often boast ultra-low expense ratios, as low as 0.02–0.05%, because they simply track a benchmark with minimal trading. Actively managed mutual funds frequently charge higher fees, sometimes exceeding 0.75–1.25%, to cover research, portfolio managers, and transaction costs. Those fees compound over the years, reducing your net returns. That said, many fund families offer no transaction fee mutual funds within their own lineup, which can offset higher expense ratios if you're making recurring investments. Section 3. Tax efficiency and capital gains distributions. ETFs offer a structural advantage for tax efficiency. When investors buy or sell ETF shares, the fund uses an in-kind creation and redemption process, swapping securities for ETF shares without triggering a taxable event inside the fund. This design generally minimizes year-end capital gains distributions. Mutual funds must sell portfolio holdings to meet redemption requests, potentially realizing capital gains that get distributed to all shareholders, even if you didn't sell your shares, creating unexpected tax bills in taxable accounts. If you're managing taxes carefully, ETFs usually have the edge for taxable portfolios. Section 4. Minimum investments and accessibility. Most mutual funds impose a minimum initial investment, commonly $1,000 to $3,000 for index or target date funds, and sometimes $10,000 plus for specialty funds. ETFs have no such minimum. You only need enough to buy one share, which can be a few dollars or even less if your broker offers fractional shares. That low barrier makes ETFs particularly attractive for investors starting with small amounts or building positions over time. You can buy $10 of an ETF and gradually scale up without waiting to meet a minimum. Section 5. Automatic investing and dividend reinvestment. Mutual funds shine when it comes to set and forget investing. You can schedule automatic purchases, dollar cost averaging, directly with the fund company at NAV, often without transaction fees. Dividends get reinvested automatically at NAV prices, keeping compounding on autopilot. ETFs require placing trades, though most brokers now support recurring ETF buys. Dividend reinvestment for ETFs depends on your broker's policy. Some reinvest at the next available price, but you may incur small bid-ask spreads or commissions. Section 6. Active versus passive management and performance. Both ETFs and mutual funds can be passive or active. Passive index funds aim to track benchmarks like the S&P 500, FTSE Global All Cap, or Bloomberg US Aggregate Bond Index. Active funds enlist managers to pick securities and seek to outperform indices. Research consistently shows that a majority of active mutual funds underperform their passive benchmarks over long horizons, especially after fees. However, select actively managed bond funds or niche sector funds can justify higher fees if their managers have demonstrated long-term outperformance and robust risk controls. Section 7. Comparing real-world examples. Example 1. Total U.S. equity. Vanguard's VTI ETF carries a 0.03% expense ratio, trades intraday with no minimum, and is commission-free at most brokers. VTSX, the mutual fund share class, has a 0.04% expense ratio and a $3,000 minimum, but offers automatic investments and dividend reinvestment at NAV. Example 2. International bonds. iShares IGOV ETF provides global government bond exposure at 0.15% expense ratio with intraday liquidity. PIMCO's actively managed mutual fund, PIMIX, charges 0.85% but aims to outperform through duration management and currency hedging. You'd choose iGov for cost and tax efficiency, or PIMIX if you trust PIMCO's active strategies and can tolerate higher fees. Section 8. Decision Framework. If cost control and tax efficiency top your list, passive ETFs are usually best. If you value automated dollar cost averaging and dividend reinvestment without placing trades yourself, mutual funds may be more convenient. If you need intraday trading, limit orders, or margin, ETFs provide the flexibility you need. If you have large sums to deploy at once, a no-load mutual fund with waived transaction fees can be an efficient way to invest. Section 9. Hybrid solutions and conversions. Many fund families offer both ETF and mutual fund versions of the same strategy, often with near-identical holdings. For example, Schwab, Fidelity, and Vanguard allow you to convert mutual fund shares into ETF shares and vice versa within the same account. This lets you start with a mutual fund for automatic investing and later switch to the ETF for tax efficiency. Section 10. Final tips and best practices. Always compare total costs. Expense ratio plus any trading commissions or bid-ask spreads. Use tax-advantaged accounts, IRAs, 401ks, ISAs, to hold tax-inefficient assets like mutual funds or high-yield bond funds. Maintain diversification. Choose broad market funds rather than niche or concentrated strategies unless you understand the added risks. Keep an eye on liquidity. ETFs with low trading volume can have wider bid-ask spreads. Opt for funds with ample daily volume. Review your holdings annually and rebalance to your target allocation to stay aligned with your goals. Before we wrap up, a quick compliance reminder. I'm not a licensed financial advisor. This content is for educational purposes only. Always consult a qualified professional before making investment decisions. Whether you choose ETFs, mutual funds, or a combination, the key is to keep costs low, stay diversified, and invest consistently. If you found this breakdown helpful, please tap the like button, share in the comments whether your team ETF or mutual fund, and subscribe to Understanding Money for more beginner-friendly investment insights. Thanks for watching, and I'll see you in the next video.